10 years to go until you retire. I know it can get scary. Where did all the time go, right? It seemed like this yesterday. You were just starting your job, just finishing school, maybe finishing your training. You finally got your first real job. You're making some good money, and then things just happen, right? You got married, and then you started having the kids, and then the vacation, then the car, then blah, blah, the dinner, then all of that. And then a summer and a winter, and a birthday came, and another birthday came. And the kids were in kindergarten, and now they're in the third grade, and the fifth grade, the eighth grade, the graduation. And here you are, 1 decade to go until you retire. 10 years, that's all you have. And you are nowhere close to having the type of money, the type of resources that you need to sustain you for the rest of your life. What do you do? Welcome back to another episode of the MD Investor. And in this video, that's what we're going to talk about. What do we do when time is far spent and we only have 10 years, about 10 years to go, and we have zero? We have paid all our bills. Our credit score is good, right? But we have nothing for ourselves, right? We have taken care of the children, we have taken care of the bills, but we have not taken care of ourselves. 10 years to go. So we're going to approach this calmly, right? There's a tendency for us to get nervous and freak out, but we're not going to freak out. We're going to take a deep breath and exhale and say, we are here. That is a fact. And we want to get here. How do we go from here to here? We're going to make smart decisions. We're going to do some housekeeping. Yeah, absolutely. Some basic stuff. We're going to get into investing stuff, but some basic stuff has to be done. Yeah, we have to look at some numbers. The first thing we have to do is, let's look at our income and our expenses. Yep. Let's look at the income we have coming in and then look at our expenses. Okay? Right? Let's look at our income and expenses. That's going to show us what's coming in and what's going out. All the bills. And then what that may help you, some of the bills that may not be necessary. Maybe the Netflix subscription or the gym subscription. Maybe something that maybe are not really necessary that we can cut out. Right? Maybe you have 4 cars. Maybe you can sell some of them, right? So we'll look at some of the expenses. Next thing we have to do is look at our net worth. Everything that we own, all of our investments, everything of value that we have, the equity we have in our homes, and then everything that we owe, all our liabilities, all the debts, the credit card debts and the student loan and the personal loan and the mortgages, and add everything up together and add everything together. And then you take your assets and you subtract from your assets your liability. That give you your net worth. It could be negative if your liability is greater than your asset. Perhaps it could be. Hopefully it is positive, right? Worst case, maybe 0. After we have those 2 numbers, then we look at where we want to be, right? We have 10 years to go. And the investments, so we look at where we want to be. Now, the variables that we have to look at in terms of getting from point A to point B is going to be the 4 levers. Usually, the 4 levers involved in investments are usually time, investments, your return on investments, and the amount of money that you invest. We already said time is frozen. We have 10 years. It's late in the game. So we already said time is far spent. We only have 10 years. So that's not a variable. That is fixed. We only have 10 years. So the only thing left are the investment, the rate of return, and how much money we're going to invest. Those are the 3 things we're going to look at. Those are the 3 variables we'll keep in mind. Now, about the investments. What are some of the investments that we can look at? Excellent question. Glad you asked. So we're going to look at three different types of investments. So first, the investments, and this is important. The first investment we'll look at is a S&P 500 index fund, right? Something that tracks the S&P 500 index, right? It's broadly diversified, will be spread out across the 500 biggest companies in America, the risk or lower, but we'll only get market returns, right? Because essentially we are the market. That's option number one. Option number two, we're going to look at a growth ETF, something that endeavors or tries to beat the market, right? We are hoping something that tries to beat the market, right? They have thrown out the slow growers, maybe the companies mainly focused on dividends, the value stocks, and I've left the real of the high growth companies. So these ETF are trying to beat the S&P 500. Okay? The third investment that we'll look at is an individual stock. Okay? So we'll kind of look at all three together and see how they perform against each other. Remember, I'm not a financial advisor, just a regular guy here on YouTube sharing my passion about personal finance. Make sure you do your own due diligence before you follow some random guy on YouTube. Okay? With that being said, let's jump into my computer. So here we are in my computer on the Vanguard website. So we have 10 years to retirement, right? So we cannot waste any time. Here we are on Vanguard's website. We're looking at Vanguard S&P 500 ETF, ticker symbol VU. This is their offering to track the S&P 500 index, right? It is a category of large blend, right? So large companies, large cap companies, right? Companies are very large. It is an index style management, meaning they're trying to track this index. And you see here from the risk reward from 1 to 5, 1 is less risky, 5 is more risky. It's a 4, right? So it's a little, so it's more, so it is somewhat risky. The S&P 500 on a whole have annualized about 10% return annually. It's not every year, but average over time, it's been about 10%. Some years it's up 22%, right? Some years it's down 22%, but on average, it averages out to about 10% per year. So right now, the the expense ratio for VU is 0.03%, meaning you're going to pay about $3 for every $10,000 invested. And the way you calculate that is you move this decimal place over 4 places, right? And it gives you the answer in cents. So you move it over 4 places, and you get 300, which is 300 cents or $3. $3 you'll pay annually for every $10,000 invested, all right? So let's look at VU. So it has so VU as so VU has been in existence since September 7th, 2010. So about 14 years old. The year-to-date performance has been about 15.3%. So it's doing pretty good in 2024. All right, we are halfway through the year, and it's already up 15%. Right, so invest in stocks in the S&P 500 index, representing 500 of the largest U.S. companies, and the goal is to closely track the index's return, which you already know. It offers high potential for investment growth. So the benchmark is the light blue, and VU is the dark blue, and you see it tracks it pretty closely, right? It tracks it pretty closely because they pick the stocks in the exact allocation, as you will see. So year-to-date return for VU has been about 11.28%, very close to the benchmark. The one-year return has been about 28%. The three-year return about 9.52%. The five-year return has been about 15.76%. It's pretty good. And the 10-year return has been about 12.65%. So now let's look at the component. So now let's look at the composition of Vu, right? Like we said, it matches the benchmark pretty closely, right? The largest component is information technology. It's about 30%, right? Both in the benchmark on the right and in the Vu on the left. About 30.6%. Those are your big companies, your Apple and your Amazon. Those are your big companies. Those are your Apple. Those are your big companies, your Apple, your Microsoft, and so on. Then we have healthcare, about 12%, right? Consumer discretionary, 9.8. Consumer communication services, 9.3. Industrial, 8.5. So, and then some lower exposure to materials, real estate, and utilities, about 2%. Those are your top 10 holdings. Name that you would know. Microsoft, about 6.95%. Apple, 6.29%. Nvidia, 6.1%. Right? We know Nvidia has been lately in the news, and it represents about 6.1% in the VU ETF. Amazon, 3.63%. Meta, Google, Berkshire Hathaway, Eli Lilly, right, which is the maker of a lot of those weight loss drugs, and JP Morgan Chase. Okay? So, let's go to our compound calculator. Okay, so here we are on the investor.gov website, our compound interest calculator. I know the last 10 years for the S&P 500 was 12%, but let's use the historical average of 10% annualized. So we're going to use 10%. So we're doing 10 years, and we're going to do 10% annually. Let's do monthly contribution. Let's start with $500 a month. Because time is short. Let's start with $500 a month. We're compounding annually. $500 a month. In 10 years, we'll have $95,000. That's not bad, guys. We only have 10 years to go. We're doing $500 a month in S&P 500, and in a decade, we have $95,000. That's good, but we have to do better. We have to do better. Let's see if we go to $1,000 a month. And remember, the goal we're trying to get to as close to $1 million as possible. We know everybody has their own numbers, but $1 million is something that people can wrap their head around. And if you need more, just use the multiplication factor. If you need 2 million, just double whatever we get. Okay, so $1,000 a month in S&P 500, and we have a 10-year time window getting 10% return, right? Which is the historical average, and we will end up after 10 years, $1,000 a month, we'll end up with $191,000, right? We know that the longer we let it run, it'll grow faster, but we only have 10 years because we started late. So $1,000 a month, we have $191,000. Not bad. That is not bad. That is not bad for a late start. Let's go to $2,000 a month because we only have a short window. Let's go to $2,000 a month. So $2,000 every month in the S&P 500 for 10 years, and let's see what we'll have. We'll have $382,000 at the end of 10 years, right? That's pretty good money. Combine that with your Social Security, you may be able to live a decent retirement, but we can do better. Let's go to $3,000 a month. At $3,000 a month, right? 10-year time frame, S&P 500, we will have $573,000. That is not bad. Such a short time frame, being focused, being diligent, and now you're ending up with $573,000. Obviously you have to get the $3,000, right? And this is where your creativity, cutting your expenses, making smart decisions in terms of car, housing, eating out, maybe getting a side hustle to get that money. You're going to have to be very motivated. So $573,000 is not bad. Let's go to $4,000 per month. $4,000 per month in 10 years in the S&P 500. And let's see what that gives us. That gives us $764,000. Better. We are almost at the $1 million, but let's keep going. Let's see if $5,000 a month will do it. We're trying to get to that one. Let's see if $5,000 per month will do it. $5,000 per month in the S&P 500 for 10 years. We will have 956,000. Almost. So it looks like we're gonna need maybe 5,100. Let's try 5,100. $5,100 or $5,100 every month into the S&P 500 over a decade, and we will have 975,000. We're gonna need. Let's try 53,000, 5,300. Let's try $5,400 per month. In the S&P 500 over 10 years, and we will have $1,032,000. So maybe 5,300 will do it. Maybe 5,300 will do it. 5,300. 5,300. $5,300 per month will just about do it over a 10-year. So $5,300 every month into the S&P 500 over a 10-year period, and you'll probably have about $1,000,000. But that's a large contribution. $5,300. A lot of people don't have that. Okay? Remember when I said that the variables to look at are the investment, the rate of return, and the amount of money. Because the time you're going to keep static at 10 years. So let's look into another investment. So you have to admit, $5,300 per month for 10 years is a little extreme. We did get to that $1 million portfolio value, but $5,300 is a lot to ask of the average person. So remember we said the factors to look at in terms of investments are the actual investment, the rate of return, the amount of money we invested, and time. Well, time is 10 years, and we can't change that because this is where we are in this video. 10 years, right? Time has been far spent. So we can't change that 10 years. If we were able to change it, the money will grow fast as time goes on, but we're frozen at 10 years. So we looked at the first investment, which is the S&P 500. Now let's look at a growth ETF, right? Let's look at a growth ETF. Let us jump to my computer. So here we are in my computer, again on the Vanguard website, looking at VUG, Vanguard Growth ETF. Remember we said that growth ETF is basically an ETF, which is a basket of stocks. They throw out all the low growers, all of the big established companies. Big companies like McDonald's who can't really grow much further. Big company that basically just paying dividend, right? Returning value to the shareholders by dividends. and they left the high growth. So these are companies that are not really maybe paying such big dividends, but they are reinvesting the money to grow that portfolio value, increase the stock value, right? So that your share price goes up to the sky. Growth companies like Eli Lilly, growth companies like all of the semiconductors. So VUG is Vanguard's offering. So VUG, it is again an index style. So it's trying to match an index. It's large growth, a growth company. 1 to 4, it's a 4 under risk, right? Risk reward, so a little more about a little more risky, right? But it's about the same risk as the S&P 500. It's a 4. The expense ratio is 0.04%, meaning $4 for every $10,000 you have invested. There is about, so the inception date is January 26th, 2004. So it's about a 20-year-old ETF. It seeks to track the performance of the CRSP US Large Cap Growth Index, right? Provide a convenient way to match the performance of many of the nation's largest growth stocks, right? The whole idea of investing in a growth ETF is because you want to beat the market. You want to beat the S&P 500. So let's look at the returns. So for VUG, the year-to-date return. So the benchmark is in light blue, which would be the CRSP, Large Cap Growth Index, and VUG is our ETF, is the dark blue. You see, they pretty much match, right? They pretty much match over every time period. They pretty much match. Year to date, about 13% return. The 1 year return is about 33%. Great. The 3 year return is about 9.7%. The 5 year return, look at the 5 year return, 18.8%. The 10 year return is 14.88%. You see that's about 2%. That's about 2 percentage points higher than VU, which tracks the S&P 500. You may say 2% was a big deal. You put in into a compound calculator 12% return and then 14%, and you see the difference those two additional percentage points make in how much money you end up having over a certain period of time. And it does make a difference. And since inception, it's about 11.19%. So yeah, that's the whole idea. You want to beat the return, right? So over the last 10 years, 14.88%, which is great. Since inception, it's been about 11.19%. But we like that 14%, almost 15% return. We like that. So VUG has 199 stocks, right? As opposed to the approximately 500 that's in the S&P 500 or in VU, the ETF. So now the exposure, there is 58% exposure to technology. This is what's driving most of the growth, right? The S&P 500 or VU was about 30%. So this is almost double the amount of technology exposure in the S&P 500. That's where the growth is coming from, 58%. Then the next biggest one would be consumer discretionary at 18%, industrial at 8.3%. Everything else is going to be pretty low. So it's very heavy in technology. Top 10 companies, considering that it's very heavy in technology: Microsoft, Apple, Nvidia, right? No surprise. Amazon, Facebook, Alphabet, Eli Lilly is a maker of those weight loss drugs, Zepbound, and so on, that's doing very well. Tesla and Visa, those are the top 10 holdings. So let's keep that 14% return in mind, and let's use that. Again, we're on our compound interest calculator from investor.gov, right? The government website managed by the SEC. Initial investment is 0. Length of time is 10 years. And our interest rate or rate of return, we're going to say our rate of return let's use, they had 14.8% over the last 10 years. So let's use 14%. Be a little conservative, 14%. Monthly contribution, let's start with $500 a month. $500 a month into VUG, and we're getting 14% using that rate. In 10 years, we'll have $116,000. Not going to do it. But remember, with the S&P 500, 10 years, we had only about $95,000. So let's crank it up. Let's go to $1,000. $1,000 a month. After 10 years, we're getting 14% rate of return. After 10 years now, $232,000. Better. Let's go to $1,500. No, let's go to $2,000 a month. Remember, with the S&P 500, we had to go to $5,300 monthly to get to right about $1 million. Now, $2,000 a month in the VUG, getting 14%. After 10 years, we will have $464,000. So we almost at $500,000. Let's go to $3,000. $3,000 per month in the VUG, getting 14%. After 10 years, we'll have $696,000. That's not bad. Almost at $700,000, and we're at $3,000 a month. Let's go to $4,000 a month. $4,000 a month. $4,000 a month for 10 years. We're getting a 14% return, and we're gonna end up with $928,000. Getting closer. Let's try $4,500 a month. $4,500 a month. $4,500 a month. And that took us over $1 million. $4,500 a month. All right, which is, let's go to $4,300 a month. $4,300 a month, and see if that'll do it. $4,300 a month gives you $997,000, right on the cusp. So it's probably gonna be about 4,300. We'll do it. 4,300, $4,400 a month. We'll do it. Let's do 4,350. 4,350. $4,350 will get us to the $1 million. Because it took, so now our monthly contribution is $4,350, which is less than the $5,300, almost $1,000 less. Putting it into VU, which only returned with a 10%. So you see, when the returns are higher, you don't have to put as much money in. You also don't have to put as much money in when you have longer time, but we're keeping time constant. So almost $1,000 less we have to put into VUG because the returns are a little higher. But $4,350 per month is still a lot of money for a lot of people. So let's see if we can do better. So we have seen so far that the higher the rate of return, the lower amount of money we have to invest because we're keeping time constant, right? We only have 10 years to invest. Almost $1,000 less that we have to invest in VUG as compared to VOO because of the 4-point different rate of return. We used 14% for VUG and 10% for VU. Because of that, we only needed $1,000, about $1,000 less, $4,350 approximately we needed. But that's still a lot of money for a lot of people. I know we only have 10 years left to retirement, but $4,350 a month is a lot. Let's see if we can do better by looking into an individual stock. And the individual stock we're going to look at is Nvidia. Let's jump to my computer. So here we are in my computer on Portfolio's lab website. And here they're comparing the stock chart of Nvidia in the blue to VOO in the orange. Right? In the year to date, Nvidia achieves a 166.34% return, which is basically triple. Nvidia pretty much tripled year to date, basically from the beginning of 2024 until now. It's already tripled, which is significantly higher than Vu's 14.60 return. Over the past 10 years, right? It's funny because we've been talking about a 10-year window. Over the past 10 years, Nvidia has outperformed Vu with an annualized return of 75.99%, which is astronomical. Over the last 10 years, Nvidia has been going crazy. It's been going up and up and up and up. Different amounts each year, but annualized, they take it over the last 10 years, it's been about 75.99% growth rate annually, while Vu has yielded a comparatively lower 12.9% annualized return. The chart below displays the growth of $10,000 investment in both assets, with all prices adjusted for splits and dividends. $10,000 invested in Vu would have grown 232%. So more than triple. So your $10,000 over the last 10 years would have been maybe now worth about $33,000, about that. But with the Nvidia, 29,000%. So it is more than 30x. So your 10,000 is more than 30x. Right? It's more than 30x. You had to be more than 30x. Significant difference. So we're going to use this rate of return of 75.99% into our compound interest calculator. So now here we are on the compound interest calculator again from investor.gov. So we're going to use that 75% annualized rate of return. And I know that past performance is no predictor of future performance, but we're going to use that because that's what we have. So we're going to use 75% annualized rate of return. Again, 10 years. We're starting with 0 monthly contribution. Let's look at $100 a month. Let's look at $100. Let's look at $100 a month because our rate of return is so high. Let's look at $100 a month. And if we can continue to get that annualized rate of return, your $100 per month after 10 years, you'd have $429,000. You see that? Because the rate of return is so high, we don't need that much money. $100 a month, and you're already at $429,000. You only have 10 years to go. Let's look at $200 per month. $200 a month at that same return of 75%. And we're already at $858,000 because our rate of return is so great. $200 a month, every month into Nvidia. In 10 years, you would have $858,000. Wow. Let's look at $300 per month. $300 per month into Nvidia. If you get that 75% rate of return, you would have almost $1.3 million just with $300 a month. We almost don't even need to continue because you've already achieved the $1 million goal we set with only $300 a month because the right investment with the right rate of return, right? But just for the fun of it, if you were to do $500 per month, $500 a month, you're already at $2.1 million because the return is so great. If you did $1,000 per month, because the return because the rate of return is so excellent, $1,000 a month, and it'll bring you to $4.29 million per month. That's why Nvidia is making people multi-millionaires by one stock, and it's only $1,000 a month. That's reasonable, right? That is reasonable because of the rate of return. Can you imagine that? $1,000 a month over 10-year period, and you end up with $4 million, over $4 million. This is the opportunity that presents itself. Now, I hope you're able to see the difference, right? With 10 years to go until retirement, even with all the mistakes you may have had, even with all the false starts, even with all the resolutions and plans and saying you were, but you actually did not, you can make up for lots of mistakes with this one investment, right? Like I said before, I know that past performance is no predictor of future performance, but all indicated, and lots of experts are saying that this is the beginning of the this is the beginning of the artificial intelligence revolution. And Nvidia is going to make lots of people multimillionaires. It's going to correct a lot of mistakes that people have had. And of course, you have to do your own due diligence and research and risk appetite and all of that. You may put a portion of your money there, and a portion of your money in the S&P 500, and a portion of your money into a growth ETF, right? Depending on what portion, right? It all depends on you. So what I hope this video shows is that it is never too late. Even if you only have 10 years to go, it is never too late. You see that with $300 a month, we're able to get to $1 million in a 10-year period because the rate of return is so great of this particular stock. We needed much more than 10 times more when the rate of return was only 14% for VUG, right? We needed $4,350 per month when the rate of return was only 14% for VUG. And we needed $5,300 every month when the rate of return was only 10%. But when the rate of return was 75%, we only needed $300 per month. So again, guys, this is the MD Investor with another video to increase our financial IQ so we can teach our children and break the cycle of generational poverty. MD Investor out.